Hello friends, today I am going to talk about financial planning and analysis, that is FP&A team. The FP&A team plays a critical role in driving business growth, optimizing financial performance and informing key decisions. Our FP&A professionals are responsible for financial planning, forecasting, variance analysis and providing strategic insights to stakeholders. In this video, I will cover 50 interview questions and answers to help you crack your FP&A interviews and advance your career in finance. If you are new to the channel or if you are not subscribed to the channel, request you to subscribe to my channel. So let's get started. Let's start with the first question. What is FP&A and why it is important? So FP&A stands for Financial Planning and Analysis, a function that oversees budgeting, forecasting, and financial performance to support informed business decisions. It's essential because it connects financial data to strategic goals, driving better resource allocation and profitability. Right? So it is one of the important function under the finance, specifically very important function for the CFO to take decisions which will impact future. Question number 2. Walk me through the three financial statements. So what are the three financial statements? The three main statements are the income statement, which shows the profitability, balance sheet shows assets, liabilities, and equity, and cash flow statement shows cash inflows and outflows. They are interconnected, offering a full picture of financial health. Third question, how does an inventory write-off affect the financial statement? An inventory write-off or write-down reduces inventory on the balance sheet, is recorded as an expense on the income statement, so reducing the profit, and indirectly impacts the cash flow statement through changes in net income. So any type of write-off will impact the P&L and your profit will come down. Question number 4. What is leveraged recapitalization? So leveraged recapitalization involves replacing equity with debt to optimize capital structure, typically used to make shareholder distribution or fund growth. It requires analyzing debt capacity, coverage ratios, and refinancing risk. Question number 5. How do you calculate free cash flow? So free cash flow is calculated by subtracting capital expenditures from operating cash flows. So if you see the formula here, operating cash flow minus capital expenditure is your free cash flow. Question number 6. Explain the difference between OPEX and CAPEX. Very commonly asked, because in industry, this is the challenging area where the accounting team will have a different view from accounting standard point of view, and the controllers or the FP&A team will have a different view because of the use of the product or use of the item in the business. Now, OPEX refers to ongoing operational expenses, while CAPEX reflects investment in long-term assets. So OPEX affects profit directly, whereas CAPEX impacts depreciation and future cash flows. Because if it is capitalized, it will be depreciated for the life of the asset. In that case, the impact on the P&L is not directly, but yes, it will be based on the life of the asset. Question number 7. Why do capital expenditures increase assets, but payroll expenses reduce retained earnings? So CapEx is capitalized as PP, plant, property, and equipment, because benefits last years, right? As I explained in the previous question. So the benefit will be for more than 1 year. While payroll is expensed as benefits are short term and it's an operational expenses, right? For the period. So it is charged to profit and loss account. And because it is impacting the profit and loss account, it impacts the return earning as well. Question number 8. Can negative working capital ever be a good thing? Yes, in industries with fast inventory turnover, negative working capital can indicate cash efficiency because the company receives cash from sales faster than it pays its suppliers. That means the credit period what you're giving to your customers is lesser than the credit period what your supplier has given to you. In that case, even though it is a negative working capital situation, but as from cash efficiency point of view, you will have good amount of cash because you are getting money before you make payment to your suppliers. Question number 9. If depreciation increases this year, what happens to net income and cash flow? Net income decreases because depreciation is an expense and it is increasing, but cash flow can increase since depreciation is non-cash item and added back on the statement of cash flows, right? Because depreciation is a non-cash item. The outflow is on the day first and the depreciation goes on amortizing every year. Question number 10. How do you approach budgeting and forecasting? Very commonly asked in FP&A interviews. So begin with historical trend, collaborate with departments for assumptions, and build models using reliable data. Regularly update forecast to adapt to changing business condition for accuracy. So it depends from company to company. Few company they do short-term forecasting and long-term forecasting, like 3 months forecasting, 6 months forecasting, and based on the actuals moment, they go and modify the forecast. Whether it is short-term or long-term, they go on modifying. Like if you see an example during COVID, it was a sudden impact on the business. So many companies they modified their forecast. So for doing a budget and forecasting, historical data is definitely required because it will give you the trend. But at the same time, you have to see the current situation of the business as well, right? There are certain business which are very seasonal. For example, during rainy season, the demand is less. In that case, for those quarters, you have to modify your budget and forecasts. Question number 11. What key performance indicators or KPI are most crucial or critical for a P&A team? So common KPI includes gross margin, EBITDA, cash conversion cycle, and working capital. These indicate profitability and liquidity, helping management track and improve performance. Question number 12. Can you explain variance analysis? So variance analysis compares actual results with budgeted figures to identify discrepancies. The goal is to understand causes like revenue shortfall or cost overrun and guide corrective actions. So it's most like you have a budget, you have an actual expenditure, compare that and find out the root cause why there is a variance so that it can help the top management to take right decisions in the right time. Question number 13. How do you perform ratio analysis? So ratio analysis is one of the major or you can say important tool for a P&A team. Okay, and why? Let's see the answer. Ratio analysis involves calculating liquidity, profitability, and efficiency ratios like current ratio, return on equity, and asset turnover to diagnose financial health. Each ratio tells a unique story about stability and performance, right? So when you say liquidity ratio, it could be like your current ratio or quick asset ratio. Then you have profitability ratio like margin analysis or margin ratios, gross profit ratios, net sales ratios, efficiencies, your all turnover ratios. So each ratios give you a different picture or health of the company. Question number 14. What is the treatment of incidental costs incurred to get the inventories to factory? So all incidental costs like freight, insurance, etc. will be capitalized with inventory cost. It is not part of your profit and loss account. It will be capitalized with the inventory. And when the consumption happens, at that time, this cost will get charged to cost of goods sold. Question number 15. What is the purpose of scenario analysis? So scenario analysis models financial outcomes under different assumptions, helping business prepare for best, worst, and expected cases. It guides risk management and contingency planning. So different scenarios are tested by the FNA team to see that how it impacts the business. Certain business are impacted by elections, for example. So during election time, or if the business sees that okay, after 3 months there is election in the state or in the country, then they take that scenario, they take the past historical scenario that how the business get impacted during the election time. So those scenarios they may examine to see that in different scenarios what is the situation of the forecast and budgeting done by the business. Question number 16. A company buys a new machine. How does this affect the three statements? So assets, that is plant, property and equipment, rise on the balance sheet because when asset comes in, the asset value goes up in the balance sheet. Cash, investing outflows drop, and depreciation expense affects income in future periods. Question number 17. What's the impact of issuing debt versus equity on financial statement? Issuing debt adds cash and liabilities. Future interest expense lowers income. Issuing equity increases cash and equity but dilutes ownership and doesn't have future payments. Question number 18. Why would two companies merge? List both financial and non-financial reasons. Nowadays, if you see in the market, lot of mergers are happening. But let's look into it. What benefit the company gets by merging? Financial reasons: synergy, market entry, cost savings, acceleration. Non-financials: executive ambition, empire building, tech access, and many more. Question number 19. How do you present complex financial data to non-financial stakeholders? So simplify results using visualizations, chart, graphs, avoid jargon, and focus on business impact to make the information accessible for informed decisions. Because not all stakeholders can understand finance. So you have to make it easier by making different graphical presentation. Question number 20. What's the difference between cash flow and profit? So profit is net results after cost on the income statement, whereas cash flow shows actual cash in and out of the business. Positive profit doesn't always mean positive cash flow due to timing difference, right? If your customers are not making payment on time, even though you have earned the profit, but the realization happens in subsequent period. Question number 21. How do you analyze variances between actual and budget? Investigate the root cause by drilling down into specifics like sales, cost, timing difference, discuss with the responsible teams, and recommend action plans where necessary. So sometimes it happens that lot of assumptions are used while preparing the budget. So when you are doing the analysis of budget versus actuals, look into the assumptions and see that whether those assumptions has been realized correctly or not. That's the reason you need to talk with different departments to see that whether the cost levers or the revenue are not achieved or not spent as per the requirement. Question number 23. What is revenue cutoff process and why it is important? So the revenue cutoff process is an accounting procedure to ensure that the revenue transactions are recorded in current accounting period, typically around the reporting date. This is important to prevent financial manipulation such as artificially inflating revenue and to ensure the accuracy and reliability of financial statements for investors and other stakeholders. So you have to ensure that IFRS 15 or Ind AS 115 is properly taken care while determining the revenue. So that means if the risk and control are still with the company, not moved to the buyer, then you can't recognize revenue. Question number 24. What is the accounting treatment of interest paid on loan taken for greenfield project? So interest on borrowings for projects will be capitalized along with the asset cost. However, after the assets are put to use, the interest cost on borrowings will be charged to profit and loss account. Question number 25. Give three examples of non-cash items which are adjusted in cash flow statement. So the first one is depreciation. Second is provision for gratuity for the provision increased during the year not paid. Third is inventory provision, where there is no write-off, only provision has been created based on the past history, or it could be like obsolescence inventory. Number 25. Is it better for a company to be highly liquid or highly profitable? It's a tricky question. So again here, the answer should be depends on goals. Liquidity means paying bills, while profitability signals long-term success. Ideally, balance both, but excess liquidity could mean missed growth. That means you have good amount of liquidity, cash, but you are not utilizing it for growth. Next question. How does an operating lease differ from capital lease, now called finance lease? So operating lease don't show as assets and liabilities. Finance lease do and depreciate over time, affecting both balance sheet and income. However, with the IFRS 16 or Ind AS 116 requires to create RO assets and corresponding lease liabilities. Question number 27. What are clean and dirty prices for bonds? So clean price excludes accrued interest. Dirty price includes it. Transactions typically settle at dirty price, but bonds quote clean price. But 28. Can you explain goodwill? How it is created and can it be negative? So goodwill arises when an acquisition price exceeds net asset value. That means, for example, at the time of merger or acquisition of any business, if the consideration is paid more than the amount of assets you are incurring, then it is a case of goodwill. It cannot be negative if asset exceeds price, record a gain. In that case, it will be a capital reserve. Question number 29. What are deferred tax assets and liabilities? How do they arise? They result from temporary differences in accounting versus tax recognition, like accelerated depreciation for taxes. So assets means future tax benefit. That means today, because of the timing difference, you are paying more tax to the government. However, that can be claimed in future. That timing difference can be claimed in future. In that case, you have a deferred tax asset. In the reverse case, where today you have saving, but you will be paying more in future year, in that case, it will be deferred tax liabilities. Question number 30. Which would you prioritize as CFO? Growth, stability, and innovation. This is also a very tricky question. It could be as a CFO or as a leader in FP&A team. Tricky because all matters, right? Answer should cite company context, risk appetite, and strategic goals, balancing growth with financial discipline. Question number 31. Tell me about a time you identified a significant financial risk and addressed it. So here you can share a specific example, like noticed a cost escalation, analysis, and action taken, for example, negotiated supplier contracts, resulting in cost saving for the company. So whatever practical experience you have on the cost side, or any particular example where you have driven a projects to make some successful benefit for the company, those all you can talk in this. Question number 32. How do you ensure deadlines are made during reporting cycle? So prioritizing tasks, use templates for efficiency, collaborate closely with teams, and use project management tools to track progress. So you should have day-to-day activity, and you should ensure that every day, end of the day, those activities are completed. So that next day you start freshly with the activities planned for that day instead of doing backlog work and then getting delayed. Question number 33. What role does APNA play in strategic decision making? So APNA translates the data into actionable insights, supporting leadership in evaluating opportunities, managing risks, and monitoring progress towards objective. It could be a case like buy or take on rent, right? Small decisions, or it could be a decision of whether we should merge or acquire any new business. In that case, also APNA has a important role in evaluating the benefit what you get by acquiring a business. So, lot of strategies are prepared by APNA team. Question number 34. What is enterprise value? So enterprise value is a measure of total firm value. And if you see the formula here, EV equal to market cap plus total debt minus cash. This is how you find out the enterprise value. Question number 35. Can you explain a dividend recapitalization? It involves raising debt to pay dividends to shareholders, used by private equity to realize returns before exit. Risks include increased leverage and interest payment, right? So you are taking over debt, and the purpose of increasing the debt is to make payment to the shareholders as dividend. Question number 36. What is sensitivity analysis in modeling? Very important. It tests how changes in assumptions, sales growth, margin rate, influence model outputs, helping identify key drivers and uncertainty. For example, one of the sensitive analysis could be your forex impact. If dollar increases by 1 rupee, how it impacts your budget and forecast, right? And the CFO will be interested to know that for each sensitive analysis, how the model or the forecasting is going to be impacted. Question number 37. Explain the concept of net present value. So NPV is the sum of discounted future cash flows minus the initial investment. A positive NPV signals a good investment. So if a company is planning to merge or acquire a business, then NPV calculation is a must to see that whether there is a benefit of taking over the business or not. Question number 38. How do you analyze working capital efficiency? So calculate days sales outstanding, inventory turnover, and days payable outstanding. Efficient working capital means quick cash cycles and fewer shortages. Question number 39. How do you use Monte Carlo simulation in finance? So it accesses the range of possible outcomes for metrics like project returns by running thousands of iterations with random variables, providing probabilistic risk estimates. So different type of models, different type of results. Next question, question number 40. How do you track and report on business performance? So set regular review meetings, use dashboards and scorecards, and deliver concise management reports focusing on KPIs and trends. Question number 41. Describe how you would value a minority stake in a pre-IPO fintech company. So use option pricing models for embedded growth optionality and venture capital methods, multiplies, discount rates to triangulate value, acknowledging liquidity and risk premiums. Question number 42. How would you design a cross-currency swap hedge? Set up a swap contract exchanging principal and interest payments in different currencies, offsetting forex risk for multinational operations. Track exposure and market rates. Be well prepared on hedging because most of the question will be there if you are joining a company where good amount of hedgings are applied if they have lot of transaction outside the country. Question number 43. What are the common pitfalls in financial modeling? So common pitfalls includes hard-coded values, lack of documentation, poor assumptions, and model overfitting or logic errors. Always review, stress test, and validate. Question number 44. A company has rising revenues but declining profits. What could explain this? So possible reason could be margin compressions, rising cost, and non-operating expenses, changing product mix, or increased competition. So be well prepared for this type of questions. This is one of the example, but be well prepared for different type of questions which may impact profitability, impacting cost and all that. Question number 45. Walk me through building an Excel financial model. Right. So begin by structuring revenue and expense drivers, input historicals, set assumptions, and link calculation across income, balance sheet, and cash flow. Sensitivity analysis and error checks are vital for creditability. Question number 46. What is the meaning of input tax credit? So input tax credit is a mechanism under the goods and service tax, that is GST, that allows businesses to offset the tax paid on purchases, that is inputs, against their tax liability on sales. Right. So any shortage after netting it off has to be paid by cash to the government. Question number 47. Describe your experience with financial modeling. So here you can discuss experience building models for forecasting, budgeting, valuation, or scenario planning using Excel or specialized software. Highlight how these models improve decision making. Question number 48. What financial software and tools are you proficient with? This is where they're trying to test you that what type of different tools you have used in your career or in which area you have experience. So mention expertise in Excel, formulas, pivot tables, macros, ERP systems like SAP, Oracle, and visualization tools like Power BI, Tableau, emphasizing efficiency and accuracy. Coming to the next question, question number 49. What are the most important soft skills for AP&A professionals? So key soft skills include analytical thinking, communication, problem solving, attention to detail, and collaboration, all vital for delivering insights and influencing decisions. Now coming to the last question, what attracts you to the FP&A role? Express interest in not just numbers but in influencing business outcomes, using data-driven insights, and collaborating across departments to drive growth and efficiency. So that's it from my side. Hope you liked this video. If you have liked it, please like this video and share with your friends. If you have not yet subscribed to my channel, request you to subscribe to my channel. Thanks for watching this video. Wait for the next video on a different finance topic. Thank you all.